Okay, students, good morning to everyone. Let's start another practice question on consolidation. That's going to be question number 7 on consolidation. After that, we'll be discussing one more question. So that's going to be total 8 questions on consolidation. And after that, after 8 questions on consolidation, we'll go towards statement of cash flows. And of course, after the completion of the syllabus, then there will be number of practice videos. They will keep coming on consolidation, cash flow, and other areas. But right now, the main objective is let's try to complete the syllabus. And when it comes to consolidation, we have discussed almost each and every concept. So let's do one more practice question. So after that, one more question on consolidation, and then we'll go towards cash flow statement. It's a 20 marks question. Prepare consolidated statement of profit and loss and other comprehensive income of blank company. For the year ended December X8, 18 marks. Calculate carrying amount of the investment in ARC company in consolidated statement of financial position. 2 marks. Let's read. Blank company has owned 35% of ARC company on 1st June X7. A very important point. Normally, when parent gets the holding between 20 to 50%, then other organization, we normally consider it as an associate. And when it comes to associate, number one, we do not consolidate associate, means we are not going to merge the sales of associate with the parent of, with the sale of parent. We don't do that. Basically, in group P&L, we just take an associate share in associate PAT. And by using equity method, we just calculate carrying amount of investment in associate. So ARC is an associate, and that is 1st June X7, the way back, because the current year is X8. Acquired 85% strip company on 1st April X8. If you count the time period from 1st April X8 till December X8, it's a 9 months. It means when we'll be consolidating parent and strip company books, we have to take subsidies each item of P&L with the time apportionment, that is 9/12. Why? Because post-acquisition period is only 9 months. And parent is having 85% holding, it means NCI holding is 15%. The following information is relevant. A fair value exercise conducted on 1st April X8 concluded that carrying amounts of a strip company's net asset were equal to their fair values, with the exception of an item of machinery, which had a fair value of 8 million in excess of carrying amount. So this 8 million, complete 8 million is a fair value adjustment. Machinery means depreciable asset. So we have to depreciate that. There will be an additional depreciation on fair value adjustment, but only for the 9 months, because the post-acquisition period is 9 months. At 1st April 2000 X8, the machinery had a remaining life 3 years. Depreciation is charged to cost of sale. So if I ignore 3 zeros, 8,000 divided by 3, this will give us the additional depreciation for the whole year. Since post-acquisition period is only 9 months, so then 9/12. So I am getting additional depreciation on fair value adjustment 2,000. And this 2,000 we will charge to cost of sale. So with this 2,000, additional depreciation on fair value adjustment, cost of sale will increase. Since acquisition, Plank company has sold goods to strip company totaling 39 million. So intra-group sale. And this intra-group sale will be eliminated gross, means it will be 39,000 will be deducted from the sales, and it will also be deducted from the cost of sale. Strip company had 1 quarter of these goods in inventory on December X8 during their Plank company. So 1 quarter, it means unrealized profit will be in the 1 quarter, that is 39,000. 1/4. We know that unrealized profit will be in the remaining stock. Out of this 39 million, or you can say 39,000, 1/4 are still in the stock of subsidiary. and parent is the seller. Plank company also sold goods to associate for 26 million, all of which our company held in the inventory. So in case of associate, 26 million is there. At December X8, all these goods had a markup as a percentage of cost. So here it will be 30 upon 130. So 39,000 1 upon 4, 30 upon 130 gives me 2250. And we know that unrealized profit on closing stock is added to COGS. Here, parent is the seller to associate. So again, unrealized profit on the stock will be added to the COGS, but unrealized profit in case of parent and associate will be eliminated according to the parent's holding. 26,000, it will be 30 upon 130. But after that, we have to multiply with the parent's holding, which is 35%. I'm getting 2,100. So since parent has sold goods to associate, so this 2,100 will also be added to cost of sale. Okay. The investment income of Plank company for the year ended December X8 includes dividend from strip company and our company. I think this point we have already discussed. If parent is getting any dividend from, let's say, subsidiary, even from associate, that will be eliminated in the group accounts. See note 4. It also includes 5 million interest receivable on loan made to strip company. So this 5 million interest is also an intra group. Basically, parent has given loan to the subsidiary, and subsidiary is, let's say, given you the interest. So this 5 million is the interest receivable from subsidiary. So it will be eliminated. So this 5 million will also be eliminated from the income of parent. So it will be eliminated from the income of parent, and this 5 million will also be eliminated from the finance cost of subsidiary, because it is interest income for the parent and it is interest expense for the subsidiary. Since it is intra-group, so it will be eliminated. The strip company paid a dividend to the shareholders, 18 million, December X8. Our company dividend is 35 million. Of course, entire 18 million does not belong to the parent. 18 million means 18,000 multiplied by 85%, that belongs to the parent. So if I take 85% of 18,000, I'm getting 15,300. I'm getting this 15,300. So this 15,300 will be eliminated. When it comes to dividend from associate, which is 35,000, obviously only 35% of 35,000 belongs to parent, which is 12250. So dividend from subsidiary and dividend from associate will be eliminated in group accounts. Okay. In Plank company's consolidated statement financial position December X7 previous year, the carrying amount of Plank company's investment in ARC is 145. This was calculated using equity method. Okay, that's a previous year amount. All other comprehensive income accrued after first April exit, unless otherwise indicated. All other items in the statement of profit and loss and comprehensive income are deemed to accrue evenly over there. So let's quickly prepare consolidated profit and loss and other comprehensive income. So I would say more or less all the adjustments we have seen earlier as well. Consolidated, statement of profit and loss, and other comprehensive income for the year ended December exit. I'm ignoring 3 zeros. So since I've already discussed all the adjustments, so I'll be a bit quick. Entire revenue of parent, subsidies revenue, then 9 by 12, and intra group sale of 39,000 will be eliminated. So revenue. Parent's revenue is 7,05,000. Subsidiary's revenue is 2,18,000. 9 by 12 because post-acquisition period is 9 months minus 39,000 intra-group sales. I'm getting 8,29,500. Now let's calculate cost of sales. Working one. Almost all the adjustments of cost of sale I have explained you. Let me show you working one here. Cost of sales. Plank company, 3,20,000. Strip company, subsidiary. It is 81,000 but 9 by 12. Why? Because post-acquisition period is 9 months, 60,750. Intercompany sales, obviously for one company it is sale, another company it is purchases, it will be eliminated. So intercompany purchases. Eliminate that 39,000. Additional depreciation on fair value adjustment will be added to COGS. Additional depreciation on fair value adjustment, that is machinery. 8,000 remaining life is 3 years at acquisition. Post acquisition period is 9 months, so 2,000. Let's add unrealized profit on a stock. That is in case of a strip company. 39,000, 1 upon 4. Markup is 30, so 30 upon 130 gives me 2,250. Parent has sold stock to the associate as well. So unrealized profit arc, 26,000. 30 upon 130, but parent's holding is 35%. So if you take 3,20,000 plus 60,750 minus 39 and all other adjustment, I'm getting cost of sale 3,48,100. So the cost of sale is 3,48,100. Here comes your gross profit. 4,81,400. Distribution straightforward parent plus subsidiary 9 by 12. Distribution cost. Parent is having 58,000, subsidiary is having 16,000, but 9 months because post acquisition period is 9 months. Admin, again the same thing. Admin cost, admin expense, 92,000 is parent, 28,000 is subsidiary, but 9 by 12. 1,13,000. Now we have to take share in associates PAT. Share in associates PAT. Let's go towards that. Profit after tax of associate. Profit after tax of associate is 92,570. We have to just take 35% of that. 92,570. It's 92,570. Simply share of associates profit after tax. So 92,517 to 35%. I'm getting 32,400. So share of associate PAT is 32,400. Now, let's take other income. Let me show you. Basically, the investment income is here. 46,000. Subsidy 9 by 12. Now we have to deduct intra-group. Number one, interest receivable from subsidy will be deducted 5,000. Dividend from subsidy is 15,300, that will be deducted. Dividend from associate will also be deducted. Repeat, parent, subsidy 9/12, interest receivable will be deducted, dividend from subsidy will be deducted, and dividend from associate will also be deducted. Let's come here. Other income. Parent is having 46,000, subsidy 2,000, 9/12 minus 5,000. That is interest receivable. Intercompany interest receivable is deducted minus 18,000 into 85% minus the dividend from associate is 35,000. Take 35% of this. So parent is having other income 46,000, subsidy is having 2,000, 9/12 minus 5,000 is interest receivable from subsidy is deducted. Dividend from subsidy, dividend from associate is also deducted. So I'm getting 14,950. Now let's go for the finance cost. Finance cost. Parent is having finance cost 12,000, but subsidiary is having finance cost 14. Now try to understand. Let me show you working two here. That is finance cost. Plank is having 12,000. Strip is having 14. But out of this 14, in the post-acquisition period, 5,000 is interest payable to Plank. So let us first deduct that. Less post-acquisition payable to Plank. Payable to Plank. Because for parent, 5,000 is interest receivable, then for subsidy, it is interest payable. So out of 14, first I've deducted 5, I'm left with 9,000. Now logically, remaining 9,000 will be time apportioned 9/12. Repeat. How will we calculate finance cost? Parent is having a finance cost of 12,000, straightforward. Subsidy is having a finance cost of 14, but out of that 14, first we have to deduct exactly, we know that 5,000 interest payable has arisen in the post-acquisition period. And that is between parent and subsidy. So first eliminate that interest payable to parent. We are left with 9,000. Basically now this 9,000 will be time apportioned 9/12. 6,750. So we can say that 9,000 is the amount which is accrue evenly throughout the year. But out of 14, 5,000 is not accrue evenly throughout the year. It has come in the post-acquisition period. So 6,750 plus 12,000, I'm getting 18,750. So basically the working to finance cost is 18,750. 18,750. Here comes the profit before tax. Profit before tax is 3,27,000. Income tax is very simple. We'll have to take parent and then subsidies 9/12. We never take associate share of tax, never. Only parent and subsidy. Income tax expense. Parent is having 51,500, subsidy is having 15,000, 9/12. 62,750. Profit for the year. So 3,27,000 minus 62,750 gives us 2,64,250. Now, if you have revaluation surplus, that revaluation surplus will be shown after PAT in the other comprehensive income. Other comprehensive income, gain on revaluation land, parent is having 2,800 and this subsidiary is having 3,000. Let's read regarding this gain on revaluation. Okay. All other comprehensive income, OCI, occurred after 1st April exit. So basically, whatever amount is there in strip companies, other comprehensive income, you will not time a portion. Why? Because what it says, all other comprehensive income occurred after 1st April. So this 3,000 gain on revaluation actually came in after acquisition. That is why there's no need to time a portion. So other comprehensive income. Simply gain on revaluation of land. Gain on revaluation of land. Parent 2,800, subsidiary 3,000. Here comes the total comprehensive income for the year. Total comprehensive income for the year. Total comprehensive income for the year is 2,70,050. And obviously, in this total comprehensive income, we have to give share to the NCI. And we have to give share to the NCI in the profit after tax as well as in total comprehensive income. So no issue at all. P&L will be a little bit longer than the usual. Profit attributable to parent's equity holder. Profit attributable to parents' equity holders. And then NCI. Let's say working 3. Whatever it comes. The amount of the profit is 2,64,250. And then we have to give share in the total comprehensive income as well. So total comprehensive income attributable to parents' equity holders. And then NCI. 270050. Now let us calculate the value of NCI. We know that parents holding is 85%, so NCI holding is 15%. NCI. So actually we have to first take subsidiaries PAT. Subsidiaries PAT. Profit after tax of subsidiaries 69,000. No, it's totally, it's here. 66,000. So strip company's PAT is 66,000. Now listen carefully. While calculating 66, we have deducted interest payable to parent. Repeat, while basically calculating 66,000, we have deducted 5,000 interest payable to parent. So let me first add back that. Don't worry. Add back post acquisition interest. So logically, in the post acquisition period, the total profit is 71,000. So why it was necessary, I'll tell you. Actually, you cannot time apportion 66. The total profit of your associate is 71,000. It is not 66,000 logically. And we have to time apportion 9/12. Logically, you're not going to time apportion 66. You have to time apportion 71. Post acquisition element. 9/12, it is 53,250. Now you will deduct the interest payable to parent. Why we added first 5,000 so that we can get the complete profit of subsidiary. Then we time apportion 9/12, and from this 9/12, we'll deduct the interest payable to parent. Interest payable to parent. That is plank. Deduct additional depreciation on fair value adjustment. Additional depreciation on fair value adjustment, which is 2,000. We will not be deducting any unrealized profit because seller is not subsidiary, seller is parent. So I am getting 53,250 minus 5,000 minus 2,000 gives us 46,250. So it means adjusted strip profit. And in this 26,250, obviously 15% belongs to the NCI. So if you take 15% of this, I'm getting 6,937. And obviously we have to give share to the NCI into total comprehensive income as well. Other comprehensive income. Subsidy is having a revaluation gain of 3,000. So I'm getting 49,250. That is strip total comprehensive income. Strip total comprehensive income. 15% of that belongs to NCI, which is 7,300. Actually, earlier when we did the questions of group P&L, there wasn't any other comprehensive income. Whenever there is other comprehensive income, so you have to give share to the NCI into subsidies, adjusted profit, as well as subsidies, adjusted total comprehensive income. So share of the profit is 6,937. So from 2,64,250, if I deduct 6,937, balancing figure I'm getting is 2,57,313. Now, it is also working 3. This is 7,387. If we deduct 7,387 from 2,70,050, I'm getting 2,62,663. Okay. And part B, we have to calculate carrying amount of investment and associate. Investment in associate. Let's take the opening value of investment and associate. Opening carrying amount is 1,45,000. Add income from associate, that is share in associate PAT. Income from associate. Income from associate means share in associate PAT, which is 32,400 we have already calculated. Then simply deduct dividend received from associate. Dividend received from associate. This is 12,250 and also deduct unrealized profit. Parent is the seller, unrealized profit is 2,100. These values we have already worked. 32,400 is the share and associate PAT. So I'm getting a carrying amount at 31st December X8, 1,63,050. So if you have received any dividend from associate, you have to deduct that while calculating the carrying amount of investment in associate. Unrealized profit will be deducted. So your final answer is 1,63,050. Students, please, after the video, do attempt this question once again. If you have any queries, you can ask in your respective WhatsApp groups. After that, we'll be discussing one more question and then we'll go towards cash flow statements. Thank you very much.